Picture a monthly business review. We're 40 minutes in. The operations director presents a margin breakdown, showing costs up but revenue holding. The CFO frowns. Her numbers show margin declining. Both executives pulled these figures from their respective systems this exact morning. Neither is fabricating a story, and neither made a calculation error. The standard corporate reflex is to put finance and operations in a room to talk through it, to get aligned. The conflict actually stems from a structural defect. The two departments pull from different systems with different timing logic, capturing two entirely separate snapshots of the business. So the next 20 minutes are spent figuring out which margin number is real. By the time the meeting ends, the actual decision, whether to hold pricing through Q4, has been postponed. Visualize the true cost on this scale. On one side, 2 to 3 hours per reporting cycle manually auditing spreadsheets. On the other side, a massive consequence, 3 to 6 weeks of delayed decisions. While leaders spend a month trying to agree on the math, the market moves on. The optimal time to adjust pricing passes, closing the strategic window entirely. Look at this line graph charting revenue performance. According to IDC market research, mid-market businesses lose 20 to 30% of their annual revenue directly to data silo inefficiencies. That drop occurs because executives are forced to make decisions too late or rely heavily on gut instinct when the data takes too long to assemble. A fragmented data infrastructure trains your leadership team to doubt their own metrics. That loss of trust creates a friction that directly drains revenue. Finance and operations data will always diverge until you fix the infrastructure. That divergence stems from 4 specific points of failure. First, disconnected systems. Finance runs on the accounting platform, while operations lives in the ERP or CRM. Without real-time synchronization bridging them, data living in 2 places produces 2 versions of the truth. Second, timing logic. Finance books revenue when an invoice is issued. Operations records the sale when an order is fulfilled. Both are defensible, but they track completely different moments in time. Third, undefined metrics. If a term like revenue isn't written down, it silently fractures into different formulas: gross, net of returns, or net of tax, living strictly in employees' heads. Finally, manual manipulation. Exporting a clean dataset and reformatting it in Excel introduces human variance. A slightly different date range or a misapplied filter breaks the data. Every time a human touches a data export, the information diverges from the automated core system. It happens invisibly, remaining hidden until the numbers are read aloud in a meeting. If you don't diagnose and fix these 4 root causes, every single reporting cycle will restart the exact same argument. Resolving this requires a governance layer. We call it the data alignment protocol. 4 specific steps that permanently fix the structural defect. Step 1. Build a metric dictionary. Before touching any software, you must write down precise, universally agreed upon definitions for every single management metric. Step 2. Nominate a system of record. You must pick exactly one home software for each metric. When a metric only has one source, it only has one version. Step 3. Eliminate manual exports entirely. Connect your system of record directly to your reporting layer, bypassing human spreadsheets to guarantee live, unfiltered accuracy. Step 4. Build a shared dashboard. When the CFO and the operations lead are viewing the exact same dashboard simultaneously, nobody has to generate separate reports. True data democratization eliminates the reconciliation meeting. The data causing the misalignment simply ceases to exist in 2 versions. Consider a 50-person professional services firm that routes its data through this single system of record. The agonizing 30-minute debate over differing software numbers completely vanishes. Leadership gains back hours of critical meeting time. The psychological posture of the organization shifts. When accuracy is guaranteed, leaders stop doubting the numbers. They lose the instinct to wait for alignment before taking action. Unified metrics accelerate executive decision cycles. A business that spots a margin signal and acts on it in 48 hours will always outmaneuver a competitor who is still busy reconciling spreadsheets. Moving your entire executive team from negotiating over conflicting data to acting on it creates a massive operational advantage. To build smarter systems, end the monthly data debate, and make faster decisions, hit the subscribe button, join the channel, and share this video with your team.